Close your eyes. In 2021, OlympusDAO offered an annual yield of 80,000%. Not a typo. Tens of thousands of investors called themselves Ohmies, chanted a game theory slogan, and poured hundreds of millions of dollars into a protocol that promised to become the reserve currency of decentralized finance. By 2022, the token had collapsed 99%. The game theory had worked perfectly against them. Imagine a financial protocol that promises you an annual percentage yield of not 5%, not 20, not 100, but 80,000%. Not a typo. Not a projection wrapped in so many caveats that the number is meaningless. 80,000% stated plainly as the current yield on a token you can buy today. And then imagine that this number, implausible as it sounds, is verifiably true, that the smart contracts are public, the calculations are auditable, the mechanics are transparent, and anyone with a blockchain explorer can confirm that yes, people are currently earning returns that, if they held for a year at this rate, would multiply their investment by a factor of 800. This was OlympusDAO in late 2021. The annual percentage yield fluctuated, sometimes reaching figures higher still, 100,000% at peak, and the protocol was accumulating hundreds of millions of dollars in its treasury. The Discord server had tens of thousands of members who called each other Ohmies. The community had a slogan, 3-3, which referenced a game theory matrix used to explain why holding the token was the rational, collectively optimal strategy. There were memes. There were celebrities in the crypto space endorsing the project. There was briefly a genuine cultural phenomenon. The story of OlympusDAO is a story about a novel experiment in monetary economics that became, under the pressure of its own success and the psychology of the DeFi bull market, something that functioned more like a religion than a financial instrument. It is a story about what happens when game theory meets human nature, when collective belief creates value and then collective doubt destroys it, and about the vulnerability of people who want to believe that the rules that govern normal financial reality have been suspended for them this time. The broader context in which OlympusDAO launched and grew is essential to understanding why it found the audience it did. The year 2021 was the height of DeFi's first great boom, a period when hundreds of protocols were competing for capital, when total value locked across the DeFi ecosystem had grown from a few $1 billion to over $100 billion, when yields that would have seemed extraordinary in any traditional financial context were being advertised routinely by protocols whose names and mechanics few outside the space could explain. In this environment, an annual percentage yield of 80,000% was not obviously more absurd than the 20 or 50 or 200% that was being offered by dozens of other protocols. The floor of plausibility had been moved by the bull market to a position that made formerly unthinkable numbers feel merely ambitious. The demographics of the OlympusDAO community were concentrated in a particular population, people who were engaged enough with DeFi to navigate the protocol's interfaces, sophisticated enough to understand at least the surface level of the game theory framing, and financially positioned to make meaningful deposits. This was not the mass retail audience of the 2017 ICO era. It was the early adopter layer of DeFi. People who prided themselves on understanding the mechanics of the protocols they used, who read white papers, who participated in governance votes, and who were therefore unusually resistant to the warning from outsiders that what they were doing looked like a bubble. The resistance to external criticism was built into the community's intellectual self-image. We understand the mechanics, you do not. Your skepticism reflects your ignorance, not our error. In the next chapter, how a pseudonymous developer known only as Zeus designed OlympusDAO from first principles in monetary economics, and how the 80,000% APY he chose to attract capital would eventually become the mechanism of the protocol's own undoing. OlympusDAO launched in March 2021, created by a pseudonymous developer known as Zeus, a name chosen deliberately, signaling the mythological ambition of what he was attempting to build. Zeus maintained his pseudonymity throughout the project's rise and fall, a fact that protected his identity but also gave the community's reverence for him an almost theological quality. He was not a face, not a LinkedIn profile, not a person you could find at a conference. He was a voice, a vision, a sustained argument written in code and in forum posts that people studied as carefully as scripture. What can be pieced together from his public writing and the accounts of people who knew him suggests someone who had come to DeFi from a background in macroeconomics and monetary theory, someone who was not primarily motivated by the prospect of personal financial gain, but by a genuine intellectual frustration with the limitations of existing financial systems. He had been thinking about the properties of money for years before OlympusDAO. What made something a reliable store of value? Why fiat currencies degraded over time, what it would mean to design a currency from first principles rather than inheriting the accumulated compromises of centuries of political economy. OlympusDAO was his answer to those questions, and he pursued it with the intensity of someone who had been waiting for the right moment and the right technology to put his ideas into practice. Zeus was not, by all subsequent evidence, primarily a grifter or a short-term opportunist. The intellectual framework he articulated in the Olympus white paper and in the detailed documentation the project published was a genuine attempt to think through a fundamental problem in decentralized finance, the problem of stablecoin instability. The history of money is, in a sense, the history of agreements about what to trust, and those agreements have never been permanent. Gold worked as a monetary standard because enough people agreed it did, and because its physical properties made it difficult to counterfeit and reasonably convenient to transport. Fiat currency works because governments require taxes to be paid in it, and because the network effects of everyone accepting it make not accepting it costly. The dollar's position as the world's reserve currency works because of the depth of U.S. financial markets, the credibility of U.S. institutions, and the historical accident of the Bretton Woods Agreement and its aftermath. None of these arrangements were inevitable. All of them could, in principle, be replaced by something better designed for the conditions of a digital economy. Zeus was not the first person in the cryptocurrency era to believe that blockchain technology offered the tools needed to create that something better. But where earlier efforts, most notably the algorithmic stablecoins that had repeatedly failed to maintain their pegs, tried to simulate the dollar's stability through mechanical means, Zeus was attempting to skip the stability requirement entirely. OHM was not trying to be worth $1. It was trying to be worth what it was actually backed by, and then some, the then some being the premium that reflected the community's belief in the protocol's future growth and utility. This premium was not irrational in principle. Premium above intrinsic value is how most assets are priced. The question was whether the premium was calibrated to realistic expectations or to a bull market's temporarily expanded sense of what was possible. The existing stablecoins in DeFi, primarily Tether and USD Coin, maintained their dollar peg through a simple mechanism. Each token was backed by $1 held in a bank account somewhere. This worked in the sense that the peg held and the tokens functioned as stable stores of value and mediums of exchange. But it came at a cost that Zeus found philosophically unacceptable. The stability was entirely dependent on trust in the institutions holding the underlying dollars. USDT and USDC were, in a deep sense, not decentralized at all. They were claims on centralized bank accounts, denominated in the currency of a sovereign state, subject to the regulatory and political authority of that state. In a world where DeFi aspired to create financial infrastructure independent of any government, the dominance of dollar-backed stablecoins was a fundamental contradiction. Zeus's proposed solution was a cryptocurrency that was not pegged to any existing currency, but was instead backed by a treasury of diverse crypto assets, with a monetary policy operated by an autonomous smart contract rather than a central bank. The token, OHM, would float freely in price, but would have an intrinsic value floor defined by the treasury assets backing each token. Unlike algorithmic stablecoins that maintained a dollar peg through elaborate balancing mechanisms, OHM didn't try to be a dollar. It tried to be something new, a decentralized reserve currency, backed by real assets, governed by its holders. The mechanics of how OlympusDAO accumulated treasury assets were clever and, in their initial conception, notably novel. The primary mechanism was bonding. Users could sell assets to the protocol's treasury, DAI, ETH, LP tokens representing liquidity positions, in exchange for OHM tokens at a discounted price relative to the market. The discount meant bonders received more OHM than they could buy on the open market, but with a vesting delay of 5 days preventing immediate resale. This mechanism allowed Olympus to accumulate treasury assets while distributing OHM to participants who were, in effect, investing in the protocol's future. The enormous APY came from staking. OHM holders could stake their tokens, locking them in the protocol's staking contract, to receive rebase rewards. Automatic increases in the quantity of OHM in their staked position, paid multiple times per day from the protocol's issuance of new OHM. When the protocol was small and growing rapidly, the ratio of new OHM issued to staked OHM was large, producing the astronomical APY figures. The APY was not technically a return paid from external income. It was a measure of how quickly the protocol was diluting its own token supply while distributing that dilution to stakers. This is the critical mechanical point, and the one that would eventually define the protocol's fate. The high APY was sustainable only if demand for OHM was growing fast enough to absorb the continuous increase in token supply. If demand held constant and supply increased by a factor of 10 over a year, which is roughly what an 80,000% APY implies, the price of OHM would collapse toward zero. The APY was, in economic terms, not a yield at all, but a measure of supply inflation. The only scenario in which it was beneficial was one in which the protocol continued to grow. Think of it this way. If a bakery produces bread and pays its workers in bread, the workers' bread-denominated wages can be very high, even extraordinary, measured in loaves per hour. But the value of those wages depends entirely on how many people want bread and what they will pay for it. Paying workers in 1,000 loaves per day is generous only if 1,000 loaves per day is worth something. Staking rewards in OHM were high because the protocol was producing a great deal of OHM. The value of those rewards depended on demand keeping pace with production. While demand and production remained in balance, the numbers were extraordinary. When demand faltered, when enough people decided they had as much OHM as they wanted, or more than they wanted, no quantity of additional OHM could substitute for the price stability that the reward numbers had assumed. The intellectual framework Zeus had developed was not without genuine merit, and critics who dismissed the entire project as obviously fraudulent from the beginning were not fully engaging with its ambitions. The problem of dollar-backed stablecoins' structural dependence on centralized institutions was a real problem. The concept of a treasury-backed reserve currency that could maintain value through assets rather than through a peg was a real concept with legitimate academic antecedents in the history of monetary economics. The bonding mechanism for protocol-owned liquidity was, as subsequent protocols would demonstrate, a truly useful innovation that survived the collapse of the OHM price. What Zeus and the Olympus team underestimated, or, in the pressure of the bull market, chose not to emphasize was the gap between the long-term vision and the short-term mechanism. The short-term mechanism was one in which the protocol needed to grow continuously to avoid a death spiral. The long-term vision was one in which OHM became a stable, widely used reserve currency that held value through genuine utility rather than speculative premium. Between the short-term mechanism and the long-term vision was an enormous space of uncertainty, a crossing that required the protocol to survive the speculative phase long enough to reach genuine adoption. The 80,000% APY was not a feature of the mature reserve currency. It was a feature of the launch and growth phase. The problem was that the community attracted by the 80,000% APY was not primarily composed of people who were thinking about what the mature reserve currency might look like in 5 years. The 3-3 slogan deserves its own examination, because it was not merely marketing. It was a sincere attempt to communicate something about the game theory of the protocol, and its success in spreading through the DeFi community reveals something about how financial movements propagate in the crypto space. The notation came from a simplified game theory matrix. Imagine 2 players, each holding OHM. Each has 2 choices: stake, hold the token in the protocol's staking contract, or sell. The matrix of outcomes in OlympusDAO's framing worked like this. If both stake, the price stays high, both earn APY rewards, both benefit. This was the best outcome, scored as 3-3. If one sells while the other stakes, the seller benefits from exiting while the staker holds a depreciating asset, scored as something like -1-3. If both sell, price collapses, both lose, scored as -3. The game theory argument was that in this framework, staking dominated selling as a rational strategy. If you believe others will stake, staking is better. Even if you believe others might sell, staking in a community where the norm is to stake is still likely better than triggering a sell cascade yourself. The equilibrium was 3-3. Everyone stakes, everyone wins. The flaw in this reasoning was that it assumed the game was repeated indefinitely with the same parameters. In reality, the optimal strategy for a participant in a finite game with uncertain endpoints is to sell before everyone else sells, which is exactly what eventually happens in every Ponzi-adjacent structure. The 3-3 meme was, in this sense, a sophisticated rationalization for behavior that was individually beneficial in the short term only as long as enough other people continued to behave as the game theory suggested they should. What made 3-3 extraordinary was not its analytical rigor, but its mimetic potency. The slogan spread through DeFi Twitter and Discord with remarkable speed. It appeared in profile bios, in tweet signatures, in Discord handles. It functioned as a tribal marker. People who displayed 3-3 were signaling their membership in the Olympus community, their commitment to the collective strategy, and implicitly their confidence in the protocol's future. The social reinforcement of the norm strengthened the actual norm. If everyone around you is staking and displaying 3-3, selling feels not just economically suboptimal, but socially deviant. The community that gathered around Olympus had a cultish quality that was openly acknowledged and even celebrated internally. Members called themselves Ohmies. There were references to Zeus as a founding figure with something approaching reverence. The Discord was, by the accounts of people who spent significant time there, an environment of high social pressure in which skepticism about the protocol was treated as apostasy and enthusiasm was rewarded with social status. To understand how this felt from inside, consider the experience of someone who joined the Discord in September 2021 at near the protocol's peak. They had read the white paper. They understood, or believed they understood, the bonding mechanism, the game theory matrix, the treasury backing concept. They had done the work that ordinary retail investors do not do, and they found themselves in a community of thousands of people who had also done the work, who were also bullish, who were reinforcing each other's analysis with more analysis, who were treating holding as the obvious rational choice, while characterizing selling as short-sighted or cowardly. The price was rising. The APY was, by any prior standard, remarkable. The people around them were sophisticated and enthusiastic. There was no single moment that looked like a bubble from inside. There was only the continuous present tense of a community in agreement, which is one of the most powerful environments for suspending independent judgment that human social life produces. The mechanics of how 3-3 spread illustrate something important about information propagation in the crypto space. The game theory framing gave community members a ready-made explanation to deploy when challenged by skeptics. When a friend or family member looked at the 80,000% APY and said, "That seems impossible," a community member who had internalized the 3-3 framing could explain, with apparent sophistication, that the APY was a measure of protocol issuance, that the Treasury provided a floor value, that the game theory showed staking was the rational dominant strategy. The explanation sounded technical and intelligent. For someone who had not already formed a skeptical view of the underlying economics, it could be persuasive. The mimetic design of the project allowed community members to become evangelists who transmitted both the social identity and the intellectual justification simultaneously. This pattern, a community where the dominant discourse provides ready-made responses to external skepticism, creates a closed epistemic environment. The responses to skepticism are themselves taught within the community, which means they have been optimized for persuasiveness within the community's own framework rather than for accuracy. A 3-3 community member explaining the protocol to a skeptical outsider was not conducting an independent analysis. They were reciting arguments they had received from a community that had a financial and social interest in persuading others. Whether those arguments were correct was a question the transmission mechanism was not designed to address. The crypto influencer ecosystem amplified this effect enormously. At Olympus's peak, prominent voices in the DeFi and crypto Twitter space were discussing and endorsing the protocol in terms that echoed the community's internal framing. Some of these voices held OHM and had obvious financial incentives to maintain enthusiasm. Others were sincerely persuaded by what appeared to be a sophisticated intellectual framework. The feedback loop between community belief, price appreciation, and social validation from influential voices was self-reinforcing in the way that speculative bubbles characteristically are. OlympusDAO reached its cultural and financial apex in late October and early November 2021. At its peak, OHM traded at approximately $1,400 per token, up from its initial price in the low single digits. The protocol's treasury held hundreds of millions of dollars in assets. The market capitalization was in the billions. The APY on staking, while lower than at launch, was still in the range of several thousand%. The Discord had grown to a size where it had become a self-sustaining cultural ecosystem, with its own memes, its own inside jokes, its own celebrities. Multiple protocol forks had launched. Projects that copied Olympus's mechanics and launched with different tokens and community names. The 3-3 meta had become a recognizable category in DeFi, with protocols like Wonderland, Klima and dozens of others running variations of the bonding and staking model. Some of these forks were launched by people who understood the mechanics and believed in the model. Others were clearly opportunistic copies launched to capture the wave of attention flowing toward the Olympus style. At this moment, the protocol was holding roughly 1,800 OHM per 1 OH minute's treasury, meaning that if the treasury's assets were divided equally among all outstanding OHM tokens, each OHM would be backed by an amount significantly less than its market price of $1,400. The premium, The gap between market price and Treasury backing was sustained entirely by the expectation of continued growth, the social dynamics of the community, and the momentum of a bull market that was making everything in DeFi look like a genius investment. The people most invested in the community were not, in the main, naive or unsophisticated. The OlympusDAO forums and the better corners of its Discord contained serious discussions of the protocol's economics, its risks, its long-term vision. There were people there who understood the game theory limitations of 3.3. There were people who were explicit that they were taking a calculated risk in a protocol that could collapse, and who had thought about what signals would tell them it was time to exit. The problem was not a lack of analytical sophistication, but the particular challenge of acting against the social grain of a community you are embedded in, particularly when doing so requires admitting that the analysis supporting your earlier enthusiasm was incomplete. The financial data from the peak reveals just how distorted the valuation had become. At OHM's price of $1,400, the protocol's market capitalization implied a valuation of something like $50 billion, larger than many established financial institutions. The Treasury backing each token amounted to perhaps a few $100s worth of assets. The remaining value, more than $100 per token, multiplied across tens of millions of tokens, was pure expectation. The belief that the protocol would grow, that OHM would become the reserve currency of DeFi, that the game would continue indefinitely. This was not hidden from anyone who looked at the numbers. The protocol published Treasury data on-chain. The math of Treasury backing divided by outstanding supply was available to anyone with a calculator. The people who held OHM at the peak were not uniformly under any illusion about this. Many understood they were holding an asset whose price included an enormous speculative premium that could evaporate. What they were betting was that they would be able to exit before the evaporation began in earnest. The exit coordination problem is one of the defining features of speculative bubbles. In theory, everyone knows that the premium is unsustainable. In practice, the premium persists because no one wants to be the first to signal that they are leaving. Doing so accelerates the collapse, and if the exit is visible on-chain, as it always is, subjects the seller to social condemnation from a community that had defined selling as apostasy. The social cost of being identified as the first significant seller in a declining market is high within the community, which creates a dynamic in which rational individual action is suppressed by social pressure until the suppression breaks down and the sell cascade begins. At that point, the first movers who had held through the social pressure find themselves in a race with everyone else for the exits. The collapse of OHM's price did not begin with a single event or a single catalyst. It began, as most crypto collapses do, with a slow erosion of the conditions that had sustained the price. In November 2021, the broader DeFi market began to show signs of cooling. Not a crash, but a flattening of the momentum that had driven everything upward through the summer. Bitcoin and Ethereum prices plateaued and then began to decline. The flow of new capital into DeFi protocols slowed. In this environment, the economics of OlympusDAO's high APY staking began to work against the protocol rather than for it. Each day, the protocol was issuing new Ohm tokens to stakers, diluting the supply, adding to the number of tokens in existence. As long as new buyers were arriving faster than the dilution, the price held. When new buyers slowed down, the math turned ugly. The OHM price trajectory through late 2021 and into 2022 was a slow decline, punctuated by brief recoveries, each recovery less convincing than the last. From the $1,400 peak in November 2021, the token fell to $900 by December, then to $500 by January, then to $200 by the beginning of February. A community that had celebrated 800 times returns found itself watching those returns dissolve with a speed that the 3-3 framework had given them no vocabulary to process. The timeline of the collapse contained several moments where interventions might have arrested or slowed it, but did not. The Olympus governance structure allowed token holders to vote on protocol parameters, the bonding rates, the APY levels, the rebase frequency. As the price declined, proposals circulated to reduce issuance more aggressively, to buy back tokens using Treasury assets, to change the mechanics in ways that might provide price support. Some of these proposals passed, some did not. What they demonstrated was that decentralized governance, whatever its other virtues, is a slow tool for crisis response. The mechanism that would have been needed to meaningfully address the decline, a rapid, decisive change in direction executed without a governance vote, was precisely the mechanism that OlympusDAO's decentralization was designed to prevent. The protocol could not act faster than its governance allowed, and its governance moved at the pace of deliberation rather than the pace of the market. The community's relationship to the team during the decline illuminated the precise tension in a pseudonymous, decentralized project between the expectation of leadership and the absence of anyone accountable enough to be blamed. Zeus posted, but Zeus was not a face or a name that could be confronted at a conference or served with legal papers. The core team communicated, but their ability to act on behalf of the protocol was constrained by governance. The community could direct frustration and disappointment at the social media accounts associated with the project, but those accounts were anonymous voices attached to positions in a DAO, not executives in a company who had fiduciary duties or legal obligations. The structure that had seemed like freedom, no centralized authority, no single point of failure, collective ownership, turned out, under the pressure of a prolonged decline, to be a structure with no one to fix things and no clear mechanism for accountability to operate through. In the Discord, the atmosphere changed in ways that were almost measurable. The confidence that had defined the channel at the peak, the easy dismissal of critics, the cheerful assertion that staking was obviously the rational choice, the sense that everyone inside the community was smarter than everyone outside it, began to fracture along the fault lines that collective belief always develops when reality to cooperate. Some members searched for explanations that preserved the core thesis. The price was falling because the broader market was falling, because whales were manipulating, because paper-handed sellers lacked the conviction that the long-term vision required. Others began asking questions that had been unwelcome at the peak, whether the APY had ever represented anything real, whether the game theory actually held, whether anyone at the top had been selling while the community had been buying. Zeus posted throughout the decline. The posts were honest in a way that was admirable and insufficient simultaneously. He acknowledged the difficulty of the market. He restated the long-term vision. He reduced the APY as the protocol adjusted its parameters to reflect the new reality of a maturing rather than hyper-growing protocol. What he could not do was undo the mathematical fact that had been visible in the design since the beginning, that the only scenario in which holding OHM was beneficial was a scenario in which growth continued and growth had stopped. The 3-3 equilibrium had dissolved, and with it, the community's confidence that they had been participants in a genuine monetary experiment, rather than, as the critics had always said, a sophisticated exercise in shared delusion. At each stage of the decline, the community's response followed a recognizable pattern. First, explanations. The decline was temporary, the market was being irrational, the Treasury backing provided a floor that made the price collapse unsustainable. Second, coordination attempts. If everyone just staked rather than selling, the pressure would ease and the price would recover. Third, accusations. People who sold were betrayers, apostates, short-term thinkers who were sacrificing the community's future for their own immediate gain. Fourth, eventual reckoning. As the price continued to fall despite all of the above, the community's social dynamics shifted. The people who had been most enthusiastic became quieter. The critics who had been dismissed became louder. The Treasury's real value, the actual assets backing each Ohm token, had never disappeared in the way that the price had. By 2022, the Treasury was still holding significant assets, and each OM was backed by a calculable floor value that was considerably higher than certain competitors in the algorithmic stablecoin space. This was, as Zeus and the protocol's supporters had argued, a genuine distinguishing feature. But it did not prevent the price from collapsing, because the price had never been equal to the Treasury backing. It had been equal to the Treasury backing plus an enormous speculative premium, and that premium had evaporated entirely. The mechanics of the collapse were self-reinforcing in a way that the 333 framework had implicitly assumed would not happen. As the price fell below certain psychological thresholds, below $1,000, below $500, below the point at which early stakers had entered, the rational calculation for each individual holder shifted. Someone who had entered at $50 and seen the price rise to $1,400 and then fall to $500 was still substantially profitable. Someone who had entered near the peak was not. For the latter group, each further decline made the case for exiting stronger relative to the case for continuing to stake. As the community of holders who were underwater grew, the social norm against selling weakened. The community that had maintained the 3-3 equilibrium through social pressure found that social pressure is itself a function of who is in the community and what their circumstances are. Once a sufficient portion of the community was substantially underwater, the social calculation changed. The protocols that had forked Olympus's mechanics and launched during the peak faced a more compressed version of the same dynamic. With smaller treasuries, less established communities, and none of the intellectual credibility that Zeus's years of thinking about monetary economics had provided, they were more vulnerable to the same pressures and less able to maintain community cohesion as the price fell. Some forks collapsed to near zero within weeks of their peak. The communities around them dissolved with a speed that their peak-era confidence had made seem unimaginable. The trail of smaller wreckage left by the fork wave, protocols that had attracted hundreds of millions of dollars in capital and returned pennies on the dollar, was, for many participants, their most direct experience of speculative mania and its consequences. The fate of OlympusDAO's forks was, in several cases, considerably worse than the fate of the original. The most dramatic was Wonderland, a fork operating on the Avalanche blockchain that reached a market capitalization of approximately $2 billion in November 2021, before collapsing under the weight of an internal scandal that had nothing to do with the protocol mechanics. In January 2022, the pseudonymous treasury manager of Wonderland, known as 0xSifu, was identified by an on-chain investigator as Michael Patryn, a co-founder of the QuadrigaCX exchange whose involvement in that platform's collapse and his prior criminal convictions for fraud were well-documented public information. Wonderland's founder, a prominent DeFi figure known as Daniela Sesta, had apparently not known Sifu's real identity when he appointed him. The revelation triggered a governance crisis, a price collapse, and a broader conversation about the accountability problems created when DeFi projects operate with pseudonymous leadership. The Wonderland collapse accelerated the timeline on which the broader 3 meta was evaluated and found wanting. If Wonderland, the project that had been closest to Olympus in ambition and community culture, could collapse in this distinct way, What did that say about the due diligence assumptions that had underwritten confidence in all of these projects? The DeFi community's post-mortem on the Olympus era produced a substantial body of critical analysis, economists explaining why the APY numbers were always illusory, game theorists explaining why 3.3 had always been a rationalization rather than a genuine equilibrium, former community members explaining the concrete social dynamics that had made critical thinking difficult. Zeus and the Olympus core team were not silent during the decline. They posted detailed updates. They reduced the APY as the protocol matured. They articulated a long-term vision in which Olympus's relevance would come not from speculative appreciation, but from the genuine utility of a decentralized reserve currency with a substantial treasury backing. This vision was not entirely abandoned. As of 2024, OlympusDAO still exists, with a treasury still holding meaningful assets and a community still engaged with the protocol. The experiment in decentralized monetary economics continues, much diminished from its peak. The 0x Sifu revelation at Wonderland introduced a dimension of the OlympusDAO era that the game theory framing had not addressed. The question of who was actually running these protocols and what their relationship to the community's interests actually was. Pseudonymity, which had been presented as a feature, allowing teams to build based on the quality of their ideas rather than the status of their credentials, turned out in the Wonderland case to create accountability gaps that had material consequences. A protocol's treasury manager, with a history of fraud and deception, could build a position of trust within a pseudonymous community that would have been impossible had their identity been disclosed. The broader OlympusDAO ecosystem's response to the Wonderland revelation was to revisit the question of leadership accountability more broadly. Some protocols in the 3.3 space had fully pseudonymous founding teams. Others had partial disclosure, some team members named, others anonymous. The community had developed norms around trusting track records established within the community rather than verified identities. And these norms had worked to the extent that building a credible track record under a pseudonym took time and consistent behavior. But the Wonderland case demonstrated that a pseudonymous track record established in one context, a competent treasury manager, provided no guarantee of character in other dimensions that mattered for trust. The DeFi community's post-mortem on this produced a gradual shift toward more identity disclosure among protocol teams, particularly for roles with significant treasury access, though the change was uneven and contested. Quantifying the losses from OlympusDAO is complicated by the protocol's mechanics. Unlike a straightforward fraud where money was taken, OlympusDAO was an open protocol whose rules were public and whose risks were, in principle, available to anyone willing to read them carefully. The people who bought OHM at $1,400 and held through the collapse to single digits lost the difference between those prices. The people who bonded assets into the treasury at various times and received OHM that then declined in value lost the spread. The people who staked and earned enormous nominal APY rewards found that those rewards were denominated in a token whose price had fallen by 95% or more. The mathematics of the staking rewards' illusory nature deserve one more pass, because they were central to how the protocol's losses were experienced by participants. Someone who entered at OHM's early price of, say, $50, staked their position, and accumulated staking rewards at the 80,000% APY over several months, might have watched their nominal token quantity multiply by a factor of 20 or 30. Their stake of 10 OHM tokens might have grown to 200 OHM tokens. During the period of price appreciation, each of those tokens was worth more than the original 10, so the nominal gains were real. But as the price declined, the nominal token quantity continued to grow through staking rewards, while the per-token price fell faster. A participant who had been watching their position in dollar terms saw something that felt like a rising staking balance offsetting a declining price, when in reality, the staking rewards were simply diluting the token supply faster than any single holder's position was growing. The APY that had seemed like a protection against price decline was, in reality, part of the mechanism of price decline. The aggregate loss across all participants was many hundreds of millions of dollars, possibly more than $1 billion, depending on how you calculate the losses from the fork protocols as well as the original. Some of these losses were offset by gains for earlier participants who had entered at lower prices and exited near the peak. The economic reality of any speculative bubble is that money doesn't disappear, it transfers. But for the people who bought near the peak on the basis of the community's confident projections, the losses were real and in many cases severe. The question of whether OlympusDAO was a fraud is a complicated one that different analysts have answered differently. The protocol's mechanics were fully disclosed. The risks were visible in the economics to anyone who analyzed them carefully. The APY numbers were verifiably accurate as a description of the protocol's issuance rate, even if they were deeply misleading as a description of the likely investment return. Zeus and the team did not obviously enrich themselves by dumping tokens on retail buyers at the peak, though their token allocations as founders were substantial and their transactions were on-chain and subject to scrutiny. The more useful framing may be not, was this a fraud, but why did so many intelligent people believe in it for so long? The answer to that question involves the distinct properties of bull markets, the social dynamics of online communities, the way that tribal belonging can compromise individual analytical judgment, and the particular susceptibility of the human mind to narratives that promise that this time the rules are different. OlympusDAO was not the first financial instrument to exploit these vulnerabilities, and it will not be the last. The distribution of outcomes across the OlympusDAO participant population was far from uniform, and this non-uniformity matters for any honest accounting. The people who entered earliest, who bought OHM in the spring and summer of 2021 at prices in the single or double digits, accumulated staking rewards at extraordinary rates and, if they exited anywhere near the peak, made returns that were life-changing. For these participants, OlympusDAO was a successful investment. Their testimony about the protocol, that it worked, that the mechanics were sound, that the community was brilliant, was honest as a description of their experience. It was also structurally misleading as advice to people who were considering entering much later. The aggregation of honest individual testimonies can produce collectively misleading information when the speaker's experiences are drawn from different points in the distribution. The Olympus bull market generated enormous quantities of honest positive testimony from early participants whose experience was genuinely positive. This testimony was consumed by potential participants at various later stages as evidence that the protocol delivered on its promises. What it actually evidenced was that the protocol delivered on its promises for people who were positioned where the early testifiers were positioned. By the time much of the most enthusiastic testimony was circulating, most of the distribution left for new participants was in territory where the experience would be very different. This dynamic, survivors speaking louder than their selection-biased position warrants, is not limited to OlympusDAO or to DeFi. It appears in every speculative episode in financial history. But the targeted structure of the OlympusDAO community, with its Discord optimized for sharing positive experiences and its social norms against selling or skepticism, amplified the signal from successful early participants and suppressed the signal from participants who were quietly underwater. The Olympus experiment despite its outcome, produced genuine contributions to the intellectual development of DeFi. The concept of protocol-owned liquidity, the idea that a protocol's treasury should own the assets that provide liquidity for its token, rather than renting that liquidity from yield-seeking outside providers, was a real innovation that influenced subsequent protocol design. Protocols that built their own liquidity bases rather than competing for mercenary capital proved more resilient to market volatility in certain measurable ways. The bonding mechanism was adapted by other protocols in forms that addressed some of the Olympus limitations. The broader conversation about decentralized reserve currency design, what it would take to create a crypto asset that functioned as a genuine store of value and medium of exchange without being pegged to a fiat currency, continued after the particular OHM experiment was chastened. The intellectual contributions were real, even if the speculative mania was not. The regulatory response to OlympusDAO and its forks was, by the standards of the space, relatively muted. Regulators had larger DeFi fires to attend to in 2022, and the legal status of algorithmic reserve currency protocols did not fit cleanly into existing enforcement frameworks. Protocol-owned liquidity, as a concept extracted from the Olympus context and applied more carefully, represents perhaps the most lasting technical contribution of the whole episode. Traditional DeFi protocols competed for liquidity by offering yield to outside providers, typically through governance token emissions that incentivized liquidity pool participation. This liquidity mining model was expensive, created structural sell pressure on governance tokens as liquidity providers sold their rewards, and was inherently unstable. As soon as a competing protocol offered better rates, the liquidity would migrate. The protocol-owned liquidity model, where the protocol's treasury accumulates the actual liquidity positions rather than renting them, addressed all of these problems at once. It was cheaper in the long run, created no systemic sell pressure, and could not be competed away. Protocols that implemented this model after the Olympus wave found it genuinely valuable, not as a get-rich-quick mechanism, but as a stable foundation for sustainable operations. The OlympusDAO case also contributed to the DeFi space's understanding of tokenomic design more broadly. The bonding mechanism and its relationship to the protocol's treasury, the interplay between APY and token supply growth, the conditions under which a high-emission design becomes self-defeating, these were all examined with much greater rigor in the years following the collapse than they had been during the rise. Protocol designers who came after Olympus had a detailed case study available to them, and while several repeated its mistakes in different forms, the intellectual framework for analyzing those mistakes was richer for the experience. Several of the fork projects attracted scrutiny related to securities law questions, but the original Olympus itself was not the subject of major regulatory action. The community's reaction to the broader trajectory was varied in the way that communities always are when a shared belief encounters prolonged disconfirmation. Some people left entirely, concluding that the whole episode had been a lesson in motivated reasoning and that DeFi protocols of this type deserved none of their remaining attention. Some people stayed, continuing to participate in the protocol at much lower levels and much lower expectations. A small core maintained deep conviction that the long-term project, a decentralized reserve currency, was worth pursuing regardless of what had happened to the speculation that briefly surrounded it. The psychological aftermath for participants who lost significant sums was, like all financial loss of this magnitude, complicated by the social dimensions of the experience. Losing money in a stock market crash or a housing bubble is painful, but carries no deliberate shame, because the investor is not also being asked to explain why they were a member of a community that actively promoted the investment and whose social norms made skepticism socially costly. OlympusDAO participants who lost money faced the additional burden of reckoning with the community context. Had they been manipulated, or had they persuaded themselves? Had the protocol deceived them, or had the Discord deceived them, or had they participated in deceiving themselves? These questions are not easily resolved, and the inability to resolve them clearly can make the processing of the financial loss harder, not easier. Some former participants channeled this complexity into advocacy, writing detailed postmortems that warned about the mechanisms they had experienced from the inside, contributing to the growing body of literature about the psychological vulnerabilities that DeFi exploits. Others found in the experience a recalibration that made them more rigorous investors, more skeptical of communities built around high-yield narratives, more attuned to the difference between an interesting intellectual framework and a sound financial investment. The people who processed the experience constructively, whatever it cost them financially, extracted something valuable from it. The knowledge of how a sophisticated speculative community operates from the inside, the social pressures, the epistemic closures, the detailed dynamics that sustain collective belief past the point where individual analysis would have counseled exit, is genuinely useful for anyone trying to navigate future iterations of the same pattern, which will come in different forms in every subsequent bull market. The OlympusDAO story does not offer a simple moral. It is not entirely a story about greed. Many of the people who participated were curious about the monetary economics and deeply interested in what a decentralized reserve currency might become. It is not entirely a story about a scam. The mechanics were disclosed, and the risks were articulable by anyone who looked. It is a story about what happens when an interesting experiment meets the psychological dynamics of a bull market, a tribal community, and the seductions of very large numbers. One dimension of the Olympus experience that has not been fully reckoned with is the role of the intellectual framework itself in sustaining the bubble beyond its natural lifespan. Pure speculative manias, the tulip bulb and the dot-com stocks and the early Bitcoin cycles, are sustained primarily by price momentum and social contagion, and they tend to collapse relatively quickly when momentum reverses, because there is no intellectual infrastructure holding them together. OlympusDAO was different. The 3-3 framework, the game theory matrix, the monetary economics vocabulary gave participants tools to defend their positions in discussions, to explain away temporary price declines, to frame skepticism as the failure of others rather than the insight of observers. This intellectual scaffolding extended the community's coherence through the early months of the price decline, allowing the social dynamics to persist long after the price had fallen to levels where pure momentum investing would have long since capitulated. The irony is that the intelligence of the community was a vulnerability rather than a protection. A community sophisticated enough to engage seriously with game theory and monetary economics was sophisticated enough to construct elaborate justifications for behavior it was engaged in for reasons that had little to do with either. The capacity for self-deception scales with the capacity for self-justification, and a community that had developed an elaborate intellectual vocabulary was also a community that had developed powerful tools for rationalizing its own continued participation. This dynamic appears in the history of sophisticated financial disasters. The mortgage-backed securities market of 2007 was populated by highly intelligent people with elaborate quantitative frameworks that justified continued participation in a market that was showing signs of fundamental dysfunction. The Long-Term Capital Management Fund, staffed by Nobel laureates and the most sophisticated quantitative minds in finance, failed catastrophically in 1998 in ways that simpler analysis would have predicted. Sophistication protects against obvious errors. It does not protect against errors that the sophisticated framework has been designed to overlook. The particular lesson that OlympusDAO offers, beyond the general lessons that every speculative episode teaches, is about the particular danger of intellectual community as an investment framework. A community of smart, engaged people discussing the properties of a financial instrument in an environment where skepticism is socially costly is not a good analytical environment. It is a very sophisticated way of being collectively wrong for longer and with better vocabulary than would otherwise be available. The clear vulnerabilities it exploited are durable features of human psychology. The desire to believe that this time the rules are different. The difficulty of maintaining analytical independence inside a community of enthusiastic believers. The way that the social costs of skepticism, being excluded, being mocked, being wrong in the short term, even if right in the long term, can override the analytical benefits of it. These vulnerabilities do not disappear when markets learn about OlympusDAO. They persist, and the next experiment that targets them will likely succeed in attracting believers for a time. What the Olympus story does offer is a clear illustration of a distinct mechanism. When a financial instrument's value is primarily sustained by collective belief rather than by cash flows or underlying assets, the game is not about analysis. It is about timing. The people who entered early and exited at the peak made substantial returns. The people who entered late, or who stayed because the community told them staying was the rational and morally superior choice, paid for those returns with their own capital. This is not unique to crypto. It is not unique to DeFi. It is the oldest story in the history of financial speculation, recurring in every era and every market. What made OlympusDAO distinctive was the intellectual sophistication of the community around it. The game theory framing that made holding feel like the principled rather than merely the hopeful choice, and the transparency of the blockchain that allowed anyone who looked carefully to see exactly how the money was moving. The transparency of the blockchain cuts both ways in this story. On one hand, it meant that anyone could verify the Treasury backing, the issuance rate, the token supply growth, and the implied fragility of the premium at any point in the protocol's history. The information needed to assess the risk was available on-chain, in real time, to anyone who chose to look for it. On the other hand, the social structure of the community created powerful incentives not to look or not to interpret what you found honestly, or to look and rationalize rather than act. The information environment was transparent. The social environment was opaque in the ways that matter most. The unexpressed doubts, the private uncertainty, the growing unease that community members did not share, because the community had defined that unease as a failure of conviction rather than a signal worth attending to. There is a regulatory dimension here that is still unresolved. OlympusDAO operated in a legal gray area that regulators in 2021 did not have the bandwidth to address. Whether OHM tokens were securities under U.S. law, whether the bonding mechanism constituted an investment contract, whether the extremely high APY advertising constituted misleading marketing, these questions were not definitively answered. As DeFi regulation has continued to develop in the years since, the protocols that survived the era have faced increasing pressure to answer them. The intellectual framework that distinguished OlympusDAO from simpler Ponzi structures, the real monetary economics, the treasury backing, the genuine innovation in protocol design, may or may not be sufficient to distinguish it from the investment instruments that securities law was designed to regulate. That question is still being worked out in courtrooms and regulatory proceedings that the OlympusDAO community of 2021 could not have anticipated. Close your eyes again, if they have opened. The protocols are still running, quietly, in the background of DeFi. Much diminished, much chastened, still operating according to the same transparent rules that anyone can read. The Treasury is still there, still backing the token at some calculable floor. The Discord still exists, with a fraction of its former membership and none of its former fervor. The 3-3 meme is mostly a memory now, a historical artifact of a distinct moment in cryptocurrency's development. And somewhere in the permanent record of the Ethereum and Avalanche blockchains, every transaction is preserved. Every bond, every stake, every sell that the community told you was a betrayal. The history of what people believed, what they paid for that belief, and when they changed their minds is written there in immutable code exactly as it happened. Let the night be quiet now. Let the complexity of markets and beliefs and communities rest. You are safe. You are still. Rest. Story end.